That's three tax rules that surprise business owners: related parties, depreciation recapture, and installment sales. So most business owners think that I can sell assets to family and deduct the loss. Sometimes I think that depreciation is always free money. Or three, they think that if I get paid over time, I can delay all the tax. And that's not always the case, okay? So today we're breaking down the three tax rules that surprise most people. So who am I? First of all, my name is Bryce Tubbs. I'm the tax strategist and founder of Virtual Accounting Strategies. We started our company in 2015. Now, we help business owners through tax planning, bookkeeping, structuring and clarity, and entity structuring. And we do those three services because when your books are clean and your strategy is right, you often keep more of what you earn. Now, let's get into the first rule that many people misunderstand. So, section one, related party sales. So, selling property to family members or controlled entities can actually trigger special tax rules. And sometimes these like losses that are created are disallowed. Now, a controlled entity, just in case you never heard that term, is usually a business or organization where you have enough ownership or influence to direct decisions. This can mean like maybe you have a majority ownership or more than 50% ownership in like many tax contexts. Maybe you have control through like family attribution rules in some cases, or maybe you have the ability to decide operations, distribution, sales, etc. So, for example, like you own 100% of an LLC, that's a controlled entity. Or let's say you own 80% of a corporation. That's likely control entity in the IRS's eyes. Next is 60% of partnership profits or capital. That's often going to be considered control. And then if you have 10% passive stock ownership, that's usually not considered controlled by itself, but there's some things that can trigger it to being considered controlled. Now, why does the IRS even care, right? If you sell assets to somebody controlled, the IRS may say that's not truly an arm's length transaction. So some rules may apply. So they can have a loss disallowance, they can have ordinary income treatment in some cases, and related party limitations. And we'll kind of discuss this as we go through this video. So that just means for all three of those things, it can be summarized in like you may lose money economically, but not receive the tax deduction right now. Another example could be like, let's say you bought 100,000 or you bought stock for $100,000. You sell it to your brother for $80,000. That is a real $20,000 economic loss to you, but the IRS may disallow the current loss because it happened between related parties. So if you're gonna do stuff like that with your brother or sister, there's other different rules and stuff you can use. Like you can use like gift taxing, or you can basically do like gifting, and there's like different gift tax as well. We're gonna make in different videos, but yeah, you just can't always use that loss straight away. Next thing, and also remember, okay, so there's also special rules for spouses, divorce transfers, and other controlled types of entities as well. And we'll talk about those either in this video or in a later video. Now, the second section that confuses a lot of people up is like business property sales. So these are called 1231s, 1245s, and 1250s. Okay. So this is where many business owners are going to get surprised. They think that I depreciated equipment for years. If I sell this equipment, the gain should be a capital gain. And that's not always. And usually with equipment, machinery, vehicles, furniture, and like depreciable business assets, it's going to be affected with this 1245. Because like sometimes I hear from like new clients in our tax strategy firm, like they say like, when I sell equipment or business assets, any profit should get lower capital gains treatment. Because remember, so there's different tax rates for capital gain versus ordinary income. So most people like it's an asset, so it should be a capital gain. But oftentimes the tax law says the gain is really they're treating it differently because it's really depreciation getting paid back or recaptured. Instead of all of that gain being capital gain, some of it might actually become ordinary income first. So if you deducted like depreciation or capture, so if you deducted depreciation, some or all the gain may come back as ordinary income when you sell it. And this is called depreciation or capture. And again, this is one of the hidden costs of doing like accelerated depreciation. So accelerated depreciation gives you bigger tax deductions like earlier, but sometimes you pay for it later when you actually sell the asset. So I'll give you a simple example of what most people are like missing with accelerated depreciation. So let's say that you buy a piece of equipment for 100,000. You deduct most of it quickly and save taxes now. But then like years later, let's say 5, 10 years, your adjusted basis or like the actual like basis of the asset is gonna be like very low or zero as it's just depreciating. Like it's just old. Or maybe you have a car and it's just old. It's all rusted out. We're not talking about like a, what is that, 1996 Honda Civic. We're talking about just a regular car that's not really that durable. Because maybe after 10, 15 years, you're selling it's all rusted out and it's really worth like close to zero. Maybe you're able to sell it for 25,000. So that $25,000, it may be taxed as ordinary income through depreciation. Just depends how much depreciation you took throughout the years. And again, this is called the hidden cost because a lot of people are so focused on I saved taxes when I bought it. I did a 179 on it. With a 179 is just depreciation on different vehicles or equipment. But they forget that when I sell it later, some of that gain may be taxed less favorably. It doesn't mean that accelerated depreciation is bad by any means. It can still be a very smart move because tax savings today could be very valuable. Also, time value of money matters. So it's like it's better to save today necessarily than wait in a lot of cases for tomorrow. And then also cash flow improves now. So sometimes cash flow is very important, especially for the survival of your business. You have no cash flow and you have no like reserves. Your business is very vulnerable to different economic changes, recessions, industry changes, technology changes, etc. So at the end of the day, just remember some deductions today can create taxable recapture later. So Section 1250 property, okay? So usually buildings and depreciable real property kind of fall under 1250. So real estate follows different rules than equipment or vehicles because buildings often use these rules. They often use Section 1, sorry, 1250 rules instead of Section 1245 recapture rules common with personal property we just spoke about. So individuals may face unrecaptured 1250 gain tax, which is about 25% in some cases, right? Now, real estate is definitely really good for tax purposes. It's just this is more of like a classification, like how do you actually deal with it? I'm not necessarily saying like real estate is good or bad using like this kind of section. Next thing is going to be 1231 benefits. So when business assets are held over 1 year and you then sell it, the tax law can sometimes give favorable treatment. So like the losses may become ordinary losses, but the gains may receive capital gain treatment. And that's why like people call Section 1231 the best of both worlds. Because if you have a loss, it can often be treated as ordinary loss that offsets your regular income. So it's protected if you lose, but then also when you win, it's also more favorable as far as like the type of tax treatment it's getting. Next is like gonna be installment sales. So installment sale, it means that you sell property, but like you receive at least one payment after the first year of sale. So this can allow some gain to be recognized over time instead of all at once. So I'll give you an example. Let's say that you sell some land for $300,000. Maybe you receive $50,000 like a down payment, but then like the rest of the payments are spread over like the next 5 years or so. So some gain may be spread over future years. But the important catch is that if depreciation recapture exists, some of that tax may be due in the year of sale, even if cash comes later. And that really surprises many sellers. Because they're like, oh, I can just time it. I won't have to claim all the depreciation if I just sell 10% of it in this year. Then every year over like the next 10 years, I just pay 10% more. So it will surprise you if you're selling like that. And again, this is why it's so important to have a tax strategist working with you. And again, it's different than CPAs. Like some CPAs don't really handle preemptive tax strategy, which is kind of like the end of the year. Oh, this is what happened. Okay, let's scramble the last minute. But this is why it's important to have this stuff like in the moment because it can really change how you go and live your economic life and like the amount of money you can end up saving. This stuff matters in real life because there's so many different rules when it comes to selling equipment, rental property, land, business assets, family transfers, and seller finance deals. And the tax result depends on how the deal is structured, not just the sales price. Okay. So again, tax planning is not just reacting after the paperwork is signed, it's planning before the sale. So who's going to buy it? When to sell, lump sum versus payments over time, which assets are being sold, depreciation exposure, entity structure, related party consequences. One smart decision can save thousands. Okay. So if you're selling some kind of rental equipment, a major business asset, or just want to understand the tax side before you start signing the paperwork, message me 1250. And what we can do is we can schedule a review to look at the asset, possible tax exposure, planning opportunities, and your smartest next move. Okay? If that's you, I'd love to see you on the call. Love to get to know you better. Love to see if I can help you out. Okay? Talk to you soon.